Now let's quickly move ahead. The Governor of the Central Bank of Nigeria, Godwin Emefiele, led a discussion on Wednesday at the African Central Bank Conference 2023, which was held at the Global Leadership Center in Johannesburg, South Africa. The conference theme is African Solutions for African Problems, Africa's Seat at the Table. All the central bank governors were also in attendance. Emefiele's speech focused on recent global dynamics as well as specific policy developments in Nigeria to address emerging shocks. Emefiele shared Nigeria's experiences with the audience and urged central bankers and financial sector regulators to be more vigilant in their regulatory and supervisory role of banks, citing the recent failures of Silicon Valley Bank and Signature Bank in the United States. The two-day conference, which began on Wednesday, March 15, will conclude today. Let's take a listen.
Let me first of all thank the Standard Bank and Stanbic IBTC for inviting me to this. Like you can see, I'm just trying to piece some pieces of papers, put on piece of papers together, because I just thought I should come over here and have some fun and take some rest for about a day or two before I go back again to Nigeria to continue our work. So no prepared speeches, because it wasn't intended that I should be making a speech here. But I've been called upon to make a few remarks, given what is happening in the global community today. But I think I must thank Standard Bank here and Imeric for the comment that he made regarding the collaboration the Central Bank of Nigeria has had with the Standard Bank as well as Stanbic IBTC in attracting investable funds like from the DFC. To Nigeria. And of course, credit goes to the Group CEO of Stanbic IBTC, Mr. Emefiele, for that. We are about to receive that fund in. I believe that before the end of this week, we should be getting the $400 million in, and of course, helps boost our funding and financing needs in Nigeria. Talking about what has happened or what is happening today globally, I think it's important for me to cast our minds back to the COVID era. COVID did create a lot of devastation to lives and livelihood globally. And after COVID, we started to see the global economy developing again. Growth was beginning to improve. Inflation numbers were good. Financial market conditions were beginning to get better. And suddenly, in 2022, another crisis came. Before then, of course, COVID created recession in very many countries, and I'm sure there's hardly any economy in the world that did not witness a recession between 2020 and 2021, but we did come out of it. But unfortunately, again, in 2022, another crisis came up, and the crisis which we're still facing today is a war between Russia and Ukraine that has unfortunately created problems for the global economy. All the forecasts that had been made by the IMF, World Bank, and other institutions began to go south. Growth began to go down. Inflationary pressures began to climb. And of course, inflation globally attained unprecedented levels. And of course, central bankers and the Feds thinks that, well, inflation being a primary mandate of monetary policy must be dealt with squarely. So in the course of 2022, practically all economists or all Fed chairs and central bank monetary policy authorities embarked on a regime of tightening. And those tightening conditions led to interest rates going up. And without any apologies, you could easily predict that interest rates will go up, and as long as the need still is there for you to combat inflationary pressure, which also has its own adverse consequences on growth. So As a result of interest rates going up, financial market conditions globally became very tight and worsened. And unfortunately, you could see a situation where you are trying to solve a problem in a country like the United States. You're trying to solve a problem of how to combat inflation. That, of course, it now has dovetailed into banking crisis in the United States, where only last week we saw that the Silicon Valley Bank has had to come down, Signature Bank down. Of course, before then, we've seen crypto exchanges or crypto companies also coming down and all that. In Nigeria, we have come very hard on cryptos, and we do not allow both people and exchanges to use the Nigerian banking system to conduct crypto business, because we believe that as long as you believe that you want to encrypt your transaction between you and another person, and us being bankers, we want to ensure that whatever transaction is going on between you and another person is decrypted for us to know what is happening, so in case there's a problem, we're able to. So that's where we stand in Nigeria, and we have no apologies for that till now. Now, so we've seen the risk crystallizing. During the pre-COVID era, we saw interest rates at low levels. We saw monetary policy accommodation. And as a result of that, banks like Silicon Valley, that were in a long period of low interest rate regime, began to invest, because in their portfolios, I'm not sure we saw large loans there, began to invest short-term funds, depositors' funds, in long-term investments. And because monetary policy became tight and unaccommodative, they began to see some losses in their mark-to-market issues. And then, of course, interest rates also went up. Because interest rates went up, depositors who needed to also access liquidity to meet interest rate or lending interest rate payment obligations, of course, started to withdraw money. In the course of withdrawing their monies, SVB started to liquidate some of those investments, and of course got to a point where it could no longer meet those deposit obligations, and that's where we are, where we are today. So the big question to the central banker is, really, why we know why banks collapse, and how come monetary authorities have not taken the pain to take regulatory measures to avoid these kind of situations? Another question is, because the major, when you say why do banks collapse, I say a major reason that contribute to bank failures is when the bank is unable to meet its depositors' demand or deposit obligations for their monies. This usually results in a run, and the central bank, the South African Reserve Bank governor did talk about. Run has been a lifelong or decade-long discussions in the midst of central bankers about what happens. But the problem is that central bankers, do we really take actions, regulatory actions that should mitigate, not entirely eliminate runs, that is reduce the incidence of runs in our banking systems, so as to reduce some of the systemic crises that we see. So if a bank collapses due to a run, why is it difficult for regulators to put in place regulations that will insulate the banking system from bank collapse? In 2008, when we saw the subprime crisis and the mortgage in 2008, that was the period when we saw Lehman Brothers, Bear Stearns, Washington Mutual came down. In fact, we're beginning to see that the risk of that contagion was beginning to get even the banks like the likes of Bank of America, the Citibank, the Wells Fargo banks, and the rest of them until the Obama administration came up to begin to give them money for them to run their operations, and luckily, within a couple of years, they were able to get out of those problems, and they paid back those monies back to government. And I was sharing some information with Sims when we had the 15 minutes break. Then in 2008, I was still the CEO of Zenith Bank. And I took time to look at the balance sheet of Citibank, I think Citibank London. In that balance sheet, and if you can go through even if you Google and you check the 5-year summary of Citibank London, you will find there that deposits plus what they call, deposit in 2008 was just about $774 billion. In 2007, it was slightly lower than that. Loans plus trading assets in the balance sheet of Citibank in 2008 was about $1 trillion naira, and $1 trillion dollars. And in 2007, it was almost $1.3 trillion. So to regulators, is it safe for depositors that a bank has a deposit of $775 billion and loans and trading assets was over $1 trillion? What are regulators doing? How did regulators prepare themselves for this kind of crisis, what I call a rainy day, the day it begins to rain? What umbrella how have you built an umbrella to ensure that depositors don't face the risk of losing their deposits? I think that must be a lesson to regulators globally. And I was watching CNN, and I saw President Biden came up and said, look, we need to now strengthen regulations. We need to talk about how to protect depositors and the rest of them, because that is the reason he's had to come up to say, look, all depositors will not lose their money. They're going to be paid even if you have deposits above $250,000 with SVB or with any of those banks. What are regulators doing about this? In Nigeria, people have always said that Nigerian banking system appears to be one of the most regulated, in fact, stringently regulated banking system. And I'm sure people like Yinka Sani, who has been CEO in Nigeria now, Group CEO of Stanbic IBTC, they know what we're talking about. We've done a couple of things. We're not saying that there are no runs. We are not saying that there are no cases where the banks run into liquidity crisis in Nigeria, but we try as much as possible to make sure that we've done our best to make sure that we protect the banks and insulate the banking system from serious occurrences like this. I think it's only in Nigeria, amongst very, very few countries in the world, that you will hear about the Central Bank of Nigeria insisting that if you, a bank, you collect, say, for instance, $100 from a customer as deposit, that today, $32.5 of that money must be kept at the CBN. It is to keep that fund to meet this kind of situations when there are crises. It's only in Nigeria, or one of those countries in the world, Nigeria, that you will find that we insist that banks must maintain a particular level of specified liquid assets as a percentage of their deposits, which we call the liquidity ratio. It's in Nigeria, one of the countries in the world, Nigeria, that you will find that we insist that banks must maintain some minimum level of capital adequacy ratios. Indeed, we also insist that even when you grant loans, at least 1 or 2% of your loans, aside from specific provisions you make for loans, but when you begin to see that those loans are running into crisis, must be provisioned against bad loans and the occurrence of non-repayment of loans. It's Nigeria, in one of those very few countries in the world, that you will find in our banking laws that if you are a bank and you declare profit, if you are a young bank, after paying taxes, that 25% of your profit must be held in a statutory reserve fund to boost your retained earnings and effectively your capital adequacy ratio. These are the kind of things that regulators need to begin to look at increasingly, because it will be difficult for you to run away from crises like this where banks, in an attempt to make money, take unnecessary risks that will crystallize and create problem and may lead to their demise. So what do you do as a regulator to make sure that you're able to insulate your banking system so they don't run into those kind of crises? That is what regulators must begin to think of aggressively. And it should now be discussion that should be held at high levels to insist that regulators must now become more and more responsible about how to protect depositors' funds. We've often said it, even in Nigeria, that we believe that when there is a crisis, we must make sure that depositors are protected. So aside from this, even when situations arise, we make sure that no depositor loses its money. Since the banking crisis of 2008, when we had a few issues, we were not lucky to have the government coming to say that they are coming to make sure that all depositors must collect their monies. In 2008, when we had the banking crisis, the United States government came up and even said what Biden said this week about protecting depositors. But some of us in our own areas, we are not that lucky that governments will come and begin to say they want to use taxpayers' monies to pay depositors to ensure they don't lose their monies. What did we do in 2008? The banks came together with the Central Bank of Nigeria and created the Asset Management Corporation of Nigeria, where we created some kind of insurance fund, which till today banks contribute a percentage of their total assets into a fund, aside from all these other cash reserve or capital adequacy or liquidity ratio that I've talked about, which is meant that when there are crises, we can draw from those insurance funds to be able to bail a bank that runs into the crisis, particularly because they have overlent a lot of money. Like we know, all bankers, what kills a bank, one of the major reasons that kills a bank, aside from the run from depositors, is bad loans. And that's why regulators must begin to be very responsible and make sure everything is done to make sure that we're able to protect, in an attempt to protect the banking system, we must make sure that depositors are protected. Because when you look at the balance sheet of an average, even 5-year-old bank, in my environment, for instance, you will find that depositors' funds is at least running to almost 10 times of shareholders' funds in those banks. So effectively, we're beginning to see that banks are owned by depositors and not by shareholders. And that's why when crises arise, you find out that we don't mind doing away with the shareholders, but we must make sure that we protect depositors. So regulators must increasingly begin to think in this direction, otherwise we'll begin to face this kind of crisis that will continue to result in runs on banks. I thank you very much.